topic that we're going to put spotlight on is with regards to the no change, that has taken place in small savings returns. What does this mean for your savings account? Basically, what will happen is that PPF will continue to offer that 7.1% and post office savings deposit will again continue to offer that 4% return that were already there in place. Now, to understand as to what this means for you and to help you understand that, we're joined by Santosh Joseph, who's the founder of Germinate Investor Services, joining us now. Santosh, always a pleasure speaking with you. My first question to you is that government has kept this unchanged again, right? Why is this decision significant right now, and what does this mean for people who have invested their money in something like a PPF or post office deposit? What does it mean for them?
Hi, good afternoon. I think for most of the people waiting for this news to come out, considering that we had a couple of rate cuts during the year, this must have been a welcome surprise, because now this is the seventh quarter in a row from April of 2024 to now, rates have not been cut, which means the people who are dependent on this return are happy to notice that this returns are going to continue. Now, this is of great importance to the people because this segment of the money is usually the stable part of the income that produces a consistent income. Now, with the government not tweaking these rates but keeping them status quo and stable and continuing with the rates, I think for people who depend on this, there is continuity, there's stability, and there's confidence that their monthly income that they depend on this remains the same. So I would see this as a great positive for the people who are in this segment of the market, this stable fixed income like product that they're depending on for whatever needs that they have. So I think it's a positive move. I think people should be happy considering that even inflation has cooled off. These rates are very good.
Okay. Santosh, in an easing rate environment, should investors still rely on PPF, NSC, etc., and post office schemes? Do you think they should still go ahead and, because we've been talking about this since the longest time, that it's not even beating inflation post the tax rate that we generally get in terms of what we get it as in hand, right? Do you think it still makes sense to invest in these asset classes?
Well, the answer is actually in the approach that we take, whether it's all or none. Now, if you're going to look at this part of your portfolio as a portion of it, then you are bound to make an equal or larger investment elsewhere that can beat inflation. Now, this is now rested that it's difficult in these small saving investments to actually beat inflation and to grow your capital, because not only inflation adjusted, but just lifestyle and the cost of living has gone up substantially over the past few years. Therefore, it is imperative that we look at the small savings plus the extra that you do in your portfolio to give you a holistic total return. So therefore, this part, even though it gives you a stable return, can only be a kind of an anchor to your portfolio. You will have to invest outside of this, and because of this giving you the stability, you will have the courage to maybe look a little more deeper for a risk reward return from a total portfolio perspective. And therefore, to such an extent, to go outside this product, whether mutual funds or otherwise, is a normal thing. Now, within mutual funds, you've got plenty of scope, and even the income can be generated through a systematic withdrawal plan, not worrying about the fluctuation in the moment or the mark-to-market experiences that one goes through. So it's not all or none. You will have to have some bit of stability and also some bit of growth built into your portfolio. Depending on one's appetite for risk, you will load up more on the stable side. But I think most people have by now gathered up the understanding that you need both spectrums, stability and growth, working for you simultaneously.
Okay, but Santosh, the question really that I'm trying to understand is this a signal that small savings may no longer beat inflation meaningfully?
I think that has also been happening already for some time right now. That's difficult because on one hand, the government also wants to take care of the people who are dependent on small savings while also trying to manage inflation. At some level, you can't be fair to both ends of the spectrum. It is prudent for the investor to realize that small savings have a limited scope in terms of helping them preserve capital, generate a steady return on income. But it's also important for people to be dependent on themselves to manage a better inflation beating asset. Now, I know it's not easy for everybody to go out there and get into inflation beating assets like maybe equities, real estate, mutual fund, and those kind of products. So therefore, this allows you interplay between both. But eventually, the more you are building a portfolio which can beat inflation, you're better off. So the answer is very clear. Eventually, you will have to be in assets that will beat inflation and not worry about meeting inflation or just return somewhere close to inflation. You will have to go slightly higher than beating inflation, and this is just part of the strategy.
Okay. So then, Santosh, for conservative savers, what's the risk of staying over allocated to these schemes?
Well, the risk of staying over allocated is over a point of time, the value of your money is going to shrink, even though you may feel the value of the money is stable. But the shrink and the effect of the shrink in the portfolio will be felt very tangibly. Maybe in a year one or year two, you don't feel it much and you're happy that your money is stable and you're getting a consistent income. But suddenly, after 3, 5 years, when you see a significant depreciation in the value of the money and the need for money, the present value of money, you will feel that you should have invested to get a more real return on the value of your money. So I'm sure the people who have watched it for the last 3 to 5 years realized even though small savings have given you stable and consistent return, it doesn't compare to what beating inflation and meeting inflation returns are required. So the answer is very, very clear. You have to look at how your money can grow greater than inflation, beat inflation, and have a net positive return.
Okay. And Santosh, then how should retirees versus working professional interpret this rate pause differently? Because somebody who's having an ongoing income has more risk appetite, right?
You're right. So the people who are having an ongoing income and actually have other sources of income will, not worry so much so about the people who have no income and they have to make their corpus work for them. Quite frankly, here the people who are not having an income but yet want to make their money really relevant would actually maybe base their portfolio based on their appetite for risk and the need for cash flow. See, we're also making an assumption that the people who do not have an income will need more return. But I think it is case to case. The people who do not have an active income but want to make their money beat inflation, here is where they can actually structure their portfolio in such a way that their today is not compromised and even their tomorrow is not compromised. See, today you don't compromise by ensuring you get a stable cash flow, but your tomorrow is not compromised when you ensure that the value of your money is staying in line with the way things are changing with inflation and the cost of goods and services that we need to consume. So you will have to at some level pay some intention to understand how this works and build a portfolio that can help you mitigate. Now, if you're having extra income, you have a longer leeway. If you don't have income, you'll have to be that much more intentional of building the right mix of portfolio.
Santosh, do you think that bank FDs or debt mutual funds look more attractive than small savings in 2026?
I definitely think that there is enough scope that within the stable income category that some bit of bank FDs and other stable mutual funds can add value to it. Now you have to realize that in fixed income or the stable part, adding value would be maybe 0.5% to 1% extra, because beyond that there's very little scope for you to make money. But within debt mutual funds and bank, you're not only diversified, but you also have different liquidity profiles that you have to keep in mind, and you also have cash flows that come little differently. So for my investor looking at small savings, bank FD and debt mutual funds, you have this gamut of services that you can choose from that takes care of liquidity, risk, and also return.
All right. Okay, Santosh, thank you so much for getting us those insights and, of course, taking out the time and speaking with us at NDTV Profit. Thank you so much.